One of the top global macro events on the docket this week is the June non farm payrolls from the United States. This is regularly one of the most market moving events that we have in an entire month. However, this month's release is going to be significantly different for a number of reasons. How should we respond? How should we go into this event risk? And how should we incorporate it into our views going forward? That's what we're going to talk about today. My name is John Kicklighter. I'm Global Head of Content here for StoneX, and we are going to concentrate on the non-farm payrolls. Now, that non-farm payrolls release that we have for the month of June comes out on Thursday. Now, that is very unusual because almost every release date for the payrolls report from the United States comes out on Friday. This is on Thursday because of the national holiday, the July 4th or Independence Day holiday in the United States, which the US markets will be closed for, and so will Washington. So data is not released on that date. This is going to have a significant influence on how the market responds to this particular release. But before we get into the market conditions, some overview of what we need to know. The non farm payrolls data and all the other labor statistics that come alongside it from the BLS comes out at 12:30 GMT or 8:30 Washington time. We are going to be looking for the headline change in non farm payrolls. That's what the NFP's references. The expectations are for a modest 110,000 jobs added. And previously, from the month of May, we had 139,000 jobs. So that would be a little bit of a step down from the previous month and something that we've seen as a trend of moderation of employment growth in the United States. Nevertheless, there has been a very long run of net positive increases in the payrolls. This is in part because the US economy is still coasting along in a positive way, but also it's an ongoing recovery from the pandemic in which many jobs were lost all of a sudden. So there is a little bit of a balance here, certainly a sense of moderation in these payroll statistics. Now, this is not the only figure that you need to watch. Of course, the level of surprise for non farm payrolls is probably the most media friendly and trader focused outcome. You do need to look at some of the other statistics that are very important in the context of labor health, and that is measures like the jobless rate. The unemployment rate is expected to rise slightly from 4.2 to 4.3%. And I would also watch the average hourly earnings. That is expected to grow by 0.3% in the month of June. And at an annual rate, it is expected to stay unchanged in its growth path at a 3.9% clip. Now, these two statistics are also probably more important in the context of the unemployment rate is really what matters to monetary policy. The Fed is a dual mandate central bank, so it focuses on employment and inflation. So that unemployment rate is actually what the Fed will focus on when it dictates whether it's going to cut rates or hold rates, which we've seen has been a significant concern as of late. We should also be watching the average hourly earnings because not only does it influence how much consumers can spend and how confident they'll be in spending in the future, it also contributes significantly to the outlook for inflation, which again is one of the important aspects of the dual mandate for the Federal Reserve in setting monetary policy. Now, before we get into the deep dive of how we should expect the markets to respond, know some of the event risk that's going to lead into it and probably build up a little bit more anticipation and adjust those expectations a little bit. We have a run of economic data that is employment focused, and it's almost a cult industry to get in before the non-farm payrolls, which generates so much attention. I will call attention to a few that I think are a little bit more important and a little bit more direct in terms of their influence. We do have the JOLTS job openings and quits, but that is going to be for May. Nevertheless, it's very important to watch that trend because it is the systemic view of what ultimately become the payrolls and overall employment level of the United States. That comes out on Tuesday at 1300 GMT. But perhaps a little bit more influential is going to be the ISM manufacturing reports employment component. So that manufacturing report is very important. We also have the service sector, which the United States is much more service sector jobs. Nevertheless, the manufacturing sector is where a lot of the trade war focus is. So we want to see how much trade war activity is impacting employment trends because it does really go to the heart of policies as we've seen them recently. Now, that will also come out, the manufacturing report, on Tuesday at 1300 GMT. The service sector report comes out after non farm payrolls. So, while important, it is not going to contribute to the anticipation of that labor report at the end of the week. I would also watch the ADP employment, private payroll employment change. That is very much a corollary to that non-farm payrolls figure. It deviates in its level of surprise, although eventually with adaptations or changes and adjustments with more data coming in, they do converge. But that initial reading for ADP, which this time around I believe is running at 85,000 jobs added, which is a bounce from the very anemic 37,000 reported in the previous month. But it is that direct corollary to non-farm payrolls to really set expectations, even though the markets have gotten very used to it deviating from the ultimate number. But on that Thursday release, we're going to be watching the markets pre-US Open, so it is certainly a catalyst that is enveloped in initial exchange rate open volatility. It does set very important intentions about how it's going to dictate monetary policy from the Federal Reserve Chairman, who has been very much pressured by US President Donald Trump, who says that interest rates should be cut significantly. He's advocated for 200 basis points from current levels, whereas the FOMC just recently, at its last rate decision, said that they have to be mindful of inflation, which is of greater concern with the tariff pass through possibly coming, something he reiterated last week in Congress in his testimony. Now, this pressure is not going to let up, and there is certainly a lot going on between that dual mandate. Is employment going to continue to deteriorate at a more exaggerated pace? Because if you look at it now, 4.2, 4.3% unemployment is not significantly high historically. Certainly not taking away from inflation if it's starting to tick up, which the PCE deflator this past week did tick higher. So if they are very data dependent, the Fed is, then they will look at this employment statistics, and anything short of a significant contraction or even a modest contraction is probably not going to register as an urgent need to adjust interest rates. If it's a very middling number in the tens of thousands of jobs added or higher, it's probably not going to change the calculus of the Federal Reserve and its monetary policy go forward. Now, the markets may read into it because they will expect that Donald Trump will seize upon that number and exaggerate the pressure on the central bank. However, the Fed has been holding very fast. So a lot of these headlines are going to be the back and forth jabs that the policy officials take against each other rather in the data itself. But that's okay because the markets are very forward looking and interpretive by nature. Now, most of the volatility you're going to get from this non farm payrolls figure is probably not going to register like it would on a standard Friday release. And that's because we're right before a big holiday liquidity drain. But that does not mean that this data doesn't matter and will not factor into future market performance. In fact, after the liquidity is restored after the long holiday week in the United States, we will see that the employment statistics will certainly add to that balance of growth potential versus inflation concern and what the Fed intends to do. Growth is itself very important for the health of the US economy and its markets, but it is also much more pressing and much more headline friendly to see that fight take on a life of its own when it comes to monetary policy. So those are the themes that we should be watching. And remember, don't write it off as a major event risk just because we don't have initial massive volatility. It will still register as very important in the go forward. All right. If you're watching it, please be mindful of the risks that it represents. If you're interested in finding more financial insights on events like the non farm payrolls and the markets at large, please like and subscribe our channel.